Okay, so this is where we were at the end of our last class. We have, to summarize, we have figured out how to calculate GDP by the two approaches, right? One of them is the income approach and the other is the expenditure approach, correct? Now here we have some other definitions. By the way, we've also looked at the definition of GNP, gross national product, correct? And we know how to get GNP from GDP. So this is what we have here. You have GDP, and from GDP, if you were to add net factor income from abroad, this, of course, would be the salary of the American engineer in Germany minus the salary of the Japanese manager here in the States, correct? When you do that, you arrive at GNP from GDP. Then from GNP, if you subtract depreciation, the gross part of GNP becomes net. So GNP becomes net national product, or NNP. If you add statistical discrepancy to net national product, you arrive at something called national income, which, by the way, is also a very commonly used phrase, national income. Now, from national income, well, if you add to this transfer payments less retained profits, and I'll explain that in a second, you arrive at what's called personal income. Okay? And let me talk about that for a second. Right, so what are transfer payments? Now, transfer payments are basically defined as incomes received by households for which the households supply no factors of production in return. So in other words, this is money received for free, right? So what again are transfer payments? Transfer payments are money received by households for free. Examples would be things like Social Security payments, disability payments, pensions. You follow me? Welfare payments. So these are called transfer payments. Now, remember that many households derive a lot of income from these sources. Particularly if you're a retired person, then Social Security is a sizable part of your income. Am I correct? However, a payment like Social Security isn't really part of GDP or GNP. Why is that? If I were to put to you the following question, is a pension or a disability payment or a Social Security payment, are those payments, even though they are part of household income, are they counted as part of GDP by the income approach? Let's think about that for a second. Would a Social Security payment, even though it is money coming into the pockets of households, would that be part of GDP by the income approach? The answer is no, because you have to ask the question, does some production lie behind that payment? Now, in the case of a Social Security payment, there is no production that lies behind it. Contrast that with a wage payment. If you're a household and you receive $1,000 of wages every month, is that part of this year's GDP? And the answer is yes, because the reason you were paid $1,000 is because you produced $1,000 worth of final goods and services. Is that correct? Let's consider $1,000 worth of profit. Let's say that you're an entrepreneur and you receive $1,000 worth of profit. Is that part of this year's GDP? Again, the answer is yes, because, well, the reason you earned $1,000 of profit is because you supplied $1,000 worth of entrepreneurial services to the economy. You produce something, right? On the other hand, if you receive a pension or a Social Security payment or a welfare payment, you produce nothing in return, correct? So when you look at the income of households, and I'm going to go back to my circular flow quickly. In this circular flow, this money that is going this way, this payment that is flowing from firms to households, Does that include Social Security and pensions and so on? They don't. Do you follow me? Because this really is factor payments. Now, what are factor payments? The four incomes received by the owners of the four resources. The owners of land get rent. The owners of capital get interest. The owners of labor get wages. And the owners of entrepreneurial talent get profit. Right? Transfer payments are not part of this. Am I making sense?
Question.
Yes.
Now, they take Social Security number of paychecks, so why doesn't that factor in?
Well, you see, they take it out of your earnings. Now, your earnings are part of this flow.
So because it's not part of the part you actually take home, does it count?
Well, that's what we're coming to now. When we talk about personal income, we'll be talking about these Social Security payments, you see. But right now, you see, what happens is a part of this money is, in a sense, diverted like this as your FICA tax. Your income tax and your other taxes. You follow me? So you have these tax payments that are, for some reason I can't seem to. Anyway. The point is that you have this flow of tax monies going from the income Y to the government, right? Now, we count the entire income as part of GDP by the income approach. Now, this money that the government takes from us working people, a part of that goes to pay Social Security to retired people. You follow me? Now, the point is, it's counted here, but when the household receives that Social Security payment, that's not really part of GDP, because that would be double counting it in a sense. You see? Perhaps this will become clearer in a second. Okay? Now here, we finally take transfer payments into account. Notice that we add transfer payments here. Because what is personal income trying to capture? Personal income is trying to capture the actual income that people have at their disposal to spend. And Social Security is part of that. A lot of retired people depend on it, for instance. So to national income, we add transfer payments. Correct? So now we're bringing it in, even though it's not part of GDP or GNP. We add it now at this stage because personal income is supposed to be a more direct measure of economic well-being, right? So we add transfer payments here. Now, we subtract retained profits. Now, why do we subtract retained profits? Because you see, GDP has included profit. Profit is the payment to the owners of entrepreneurial talent, the entrepreneurs. Is that correct? But some of this profit that a corporation, for instance, earns isn't paid out to the shareholders, right? If you consider a company like Apple, who are the entrepreneurs in that company? If you consider a large corporation, and for some reason, hang on a second. So let's say that we have a corporation, and this corporation earns some profit. Now this profit is part of GDP, is that correct? But really, who are the entrepreneurs of a corporation? Can somebody tell me? Let's say we have a large company like General Motors. Who are the entrepreneurs of this company? Pardon me? No, the CEO is an employee. The CEO is an employee. He's supplying his labor. He's on the payroll. You see what I'm saying? Pardon me? No, everyone who works in that company is an employee. Everyone who works for the corporation is an employee selling labor, earning wages. So who earns the profit then? Who are the entrepreneurs of a company like GM? The shareholders, the people who own the company. Now, GM isn't owned by a single person, you see. GM is owned by millions of people who own stock in this company. Is that correct? So the shareholders are the entrepreneurs. And they are supposed to get this profit in the form of dividends. You see, when you own a share, you are supposed to be paid a sum of money for every share you own every year. The company is supposed to pay out dividends on the shares that shareholders own. Yes, go on. Well, it depends. It could be every year, it could be some time period. Correct? It depends. Now, some companies pay it every month, some may pay it once a year or something. Right? So profits are supposed to be disbursed to shareholders as dividends. But sometimes the corporation decides not to pay out all of its profits as dividend. In other words, some profit is retained by the corporation. So this is profit that is earned. It is part of GDP, but it, in a sense, doesn't make its way back into the pockets of households. Not really. Correct? That is why at this point here we subtract retained profits, because we want to get a handle on the incomes that households actually receive. You see? So what is happening in this stage? We're doing two adjustments here. First, we're counting transfer payments, which are not counted as part of GDP. Now we're counting it. Why? Because even though transfer payments are not part of GDP, they do make up people's incomes. Correct? We are subtracting retained profits, because even though profit as a whole is part of GDP, some part of this profit is really not making its way back into the pockets of households. This is profit that the corporation has decided not to pay out as dividend. Right? So we subtract that, because that is money, even though it is profit, even though technically it is part of GDP, it is money that really doesn't go into the pockets of households. So we subtract it. Am I making some sense here? And from personal income, the last thing that remains is the income taxes that we pay. And when we subtract income taxes, we are left with what is called disposable personal income. So this is the amount of income that is actually at our disposal for us to spend and live off. Right? So if you want a number that is going to tell you something about how well off Americans truly are, then this is your number. Disposable personal income. That is the closest measure of the amount of income that Americans have at their disposal. Right? So these are the various entities here that make up part of this discussion of GDP. So the important ones, of course, are GDP and GNP, right? But then you have all these others as well. Okay? And now we come to this important distinction between real GDP and nominal GDP. Okay? So let me give you an example again. Let's say that this year, the US economy produced 100 pounds of apples and 100 pounds of oranges. Right? And let's say that the price per pound of apples is $2 a pound, and the price per pound of oranges is also $2 a pound. Right? Using these numbers, could you figure out the US's GDP? Well, what is GDP again? It is the market value of final goods and services produced in the States, right? Now, these are both final goods. Let's assume both are final goods bought by consumers, right? So how would we turn these physical quantities, pounds of apples, pounds of oranges, into money? How would we do this? How would we arrive at market value something? We would basically use the prices per pound to convert these physical quantities into money. Is that correct? So what would we do here? So GDP then is equal to 100 pounds of apples times $2 a pound, plus 100 pounds of oranges times $2 a pound, and that gives us $400 GDP. Is that correct? Now let's say that last year, the economy also produced 100 pounds of apples and 100 pounds of oranges. So the actual output of the nation was the same last year, only that last year the prices of apples and oranges were lower. Apples cost $1 a pound last year, and oranges also cost $1 a pound last year. So what was GDP last year then? GDP last year then was $200. Is that correct? Yes? So we have a $200 figure for GDP from last year. We have $400 for GDP this year. Could we say that GDP has doubled between last year and this year? That's the question I'm asking. Could you say that GDP has doubled? Could you say that Americans are now twice as better off on average than they were last year? Because remember, GDP is also the income of households. Is that correct? From our circular flow of income idea. Right? Can we say that Americans this year are twice as well off as they were last year? Could we say that? Any thoughts? GDP has doubled. We can't. We can't say that, and I'll tell you why. I'll give you two ways to think about this. First, when I put a dollar sign from now on, I'm going to put a date below the dollar sign. So this is going to be GDP from the year 2015. So this is a dollar sign with 2015 written below the dollar sign. This dollar, on the other hand, is a 2014 dollar. Now, so you have two kinds of dollars. You have a 2015 dollar and you have a 2014 dollar. Are the two dollars comparable? Is the question. Can you compare them? Let me ask you another question. Let's say that you have a peso amount. Let's say you have 100 pesos. The sign for a peso is the same as a dollar sign, isn't it? And so this is Mexican. And then we have, are the two dollars comparable? Can we directly compare them? Can we say 100 and 100, they're the same? We can't, right? Why? Because they are two different currencies. Is that right? Right? I'm going to now propose to you that the US dollar with a different date below it are really two different currencies. You can think of them as two different currencies. Why is that? Because of the value it had at the time. Exactly. This example can be made more stark by comparing a dollar from the year 1960, when your grandparents were young people, say, and a dollar from today. Would you say that the two are the same? Clearly no, right? Because a dollar in 1960 could buy a whole lot more than a dollar can today. Yes, because prices were cheaper. The dollar in 1960 could buy more than a dollar today because things were cheaper. In other words, a dollar from 1960 is not the same thing as a dollar today. You can treat them as different currencies, really. You get my point? So, we have a $400 here and we have a $200 there, but really they are different currencies. So you can't compare them. You can't say that 400 is twice 200. You can't say that because the $2 are different dollars. A dollar with a date below it now is a different currency than a dollar with a different date below it. So that's one way to think about this. Right? I'll give you another explanation of why, even though GDP this year is twice that last year, Americans are not twice as better off. In fact, they are exactly as well off as they were last year. Why is that? Because our well-being really depends upon our real output. The apples and oranges that we actually produce determines our well-being, not their monetary value. And you see here that the output of apples and oranges was exactly the same last year as this year. Now remember, we actually live on apples and oranges. That's what we really eat. Is that correct? So since there was no difference, no change in the actual physical output of goods and services between last year and this year, Americans are actually just as well off this year as they were last year. There's no improvement, really, even though 400 is twice 200. So that is another way to think about this. Right? So what am I saying here? I'm saying that you really can't compare the $400 to the $200. You can't compare them, because they are really different dollars. Right? And so what are these dollars called? And these dollars are what are called nominal dollars. So that's what nominal GDP is. What is nominal GDP here by this definition here? Nominal GDP is the value of the final goods and services produced in a given year expressed in the prices of that same year. So that would be the $400 and that would be the $200. Because what do we do in each case? We took the physical output of apples and oranges and we converted them into money terms by using the prices from those years. We used a price of $2 a pound for apples and $2 a pound for oranges for 2015. And we used $1 a pound for apples, $1 a pound for oranges from the year 2014. So these are nominal GDPs. So what is my point here? My point here is that nominal GDPs may not be compared. You can't compare them. The nominal GDPs from 2 different years, you can't compare them because they are different currencies, really. Right? So in order to compare GDP across time, we need something called real dollars. We need real GDP. So what is real GDP? It says here, real GDP is the value of the final goods and services produced in a given year, expressed in the prices of the base year. In other words, we have to designate a base year. A base year is going to be a year that we, well, the base year is the year whose prices we are now going to use. We are not going to use the prices of every year. We're going to use the prices of 1 year. And that year is called the base year. Right? So let's proceed to our next slide and see how this is done. Okay? So here we have 2 years, 2005 and 2011. And you have these 3 goods, T-shirts, computer chips, and security services. Okay? Computer chips make up consumption spending. Sorry, T-shirts make up consumption spending. Computer chips make up investment spending, the purchase of machines by businesses. Security services are part of government spending on, say, national defense. So you have 10 million units of T-shirts, 3 million units of computer chips, and 1 million units of security services produced in 2005. These were the prices per unit. Correct? So if we multiply these, we arrive at these, correct? And so what is this $100 here? What would you call that? Would that be real GDP in 2005, or would that be nominal GDP in 2005? Well, what kind of dollar is this? What date do I have below this dollar sign? Well, that would depend on the dates below these dollar signs. What are these dollar signs? Aren't they all $2005? They are prices from 2005, after all, right? So if those dollars are $2005, it follows that this dollar should be a $2005, isn't it? So what is this then? Isn't this nominal GDP in 2005? Yes? Okay, now let's do the same thing for 2011. In 2011, the output of T-shirts fell from 10 million units to 4 million units. Computer chip production fell as well. But the production of security services went up. You see, so this could be because the US was involved in foreign wars or something. And T-shirt and computer chip production has fallen because these goods are now largely produced abroad, you see. We import our clothing mostly. And computer chips are made in countries like South Korea and Taiwan these days, right? Now let's convert this into money terms. So these are the prices in which year? 2011, right? So what date do I have below these dollar signs? What date do I have below these dollar signs? 2011, correct? So let's multiply these, and that would give us these dollars. And so what is this $300? This is a 2011 dollar, of course, and that would be nominal GDP in 2011. We can't compare these. These amounts are not comparable. Right? So what are we going to do to compare them? We are going to have to figure out real GDP. What is real GDP? First, we have to designate one of these years as the base year. Right? And the way the book works it out, the book chooses 2005 as the base year, which means that we are now going to evaluate the physical outputs in both years using 2005 prices. We're going to use a common set of prices. Do you follow? So what are we going to do then? We are going to evaluate the 4, 2, and 6 using which prices? Using those prices. Yes? Now, once we choose 2005 to be the base year, wouldn't it be true now that nominal GDP in 2005 is the same thing as real GDP in 2005? Isn't that true? Because after all, 2005 prices are being used. 2005 is the base year, right? So this is true, right? Now let's work out real GDP in 2011. And that would be this. Right? So we take the physical quantities, but now we are using what prices are these again? These are 2005 prices. And we arrive at 160 million 2005 dollars. Right? So what is this again? This is real GDP in 2011. Real GDP in 2011. And we can now compare the two. We can compare this with this, because this is also a 2005 dollar. So these two now may be compared. Right? So going by this, we can say now that in 2011, real GDP rose 60% as compared to 2005. And we can use this to roughly say that Americans as a whole are 60% better off in 2011 as compared to 2005. Right? Because GDP, after all, is output, but it's also the income of households, correct? So this is how we get real GDP. Now, what are the uses of real GDP, of course? The main use is to compare over time. Because we know that nominal GDPs can't be compared. They are different currencies. So what we do with real GDP is we use it to compare GDP across time. So we can now say that, well, our economy is growing, for instance. We can say that by comparing real GDP this year to real GDP in the past. Or we can say our economy is shrinking if real GDP today is smaller than real GDP in the past. Right? So we can keep track of what is happening to our economy. We can compare the standard of living over time, because GDP is going to tell us something about the standard of living. Am I correct? This is something that GDP is a good indicator of, right? Or rather, real GDP is a good indicator of, right? The second point is kind of like the first one. The second one is also comparing GDP across time, but now the purpose is to track the course of the business cycle. So in point number one, what are we trying to do? We were trying to figure out what is happening to US standards of living across time. Number two is looking at exactly what is happening to our economy in terms of the business cycle. Now, what is the business cycle? The business cycle is the ups and downs of our economy. In other words, if we have a graph like this, but time is measured here, and real GDP is measured on that axis. The up and down of the economy is called the business cycle. So here we have a peak of our business cycle. Our economy is booming, in other words. And then we enter a recession. And then we bottom out, and this is called the trough of our recession, of our business cycle. And then we begin to expand again. Right? So in order to figure out whether our economy is in recession or are we expanding, we need, again, to compare GDP across time. And in order to do that, we need real GDP. We can't work with nominal GDP. Is that correct? We can't work with nominal GDP because nominal GDP can't be compared across time because they are measured in different dollars, different currencies. Right? So this is the second use of the real GDP. And the third use is to compare the standard of living among countries. In other words, to compare the US to, let's say, Mexico. The US versus Mexico. So in order to do that, what would we do? We would not go across time or anything. We're looking at the same year. So let's say 2015 is the year we're looking at for both countries, right? So how would we compare the standards of living between the US and Mexico? Well, we have the US's real GDP in 2015. We have Mexico's real GDP in 2015. Of course, this is measured in US dollars, and this is measured in pesos, which is, I'm going to just put a P there for pesos, right? So in order to do this comparison, what would we need to do first? We would have to convert the peso. We would have to convert into US using the exchange rate, for instance. Although there is a problem with that, and I'll talk about that in a bit. Right? So this would enable us to compare standards of living in the US to standards of living in other countries. Correct? Now, how do we actually get a handle on the standard of living? I've said that the standard of living may be measured, by GDP, is what I've been saying so far, correct? But now we're going to get a little more accurate about this. When we speak of the standard of living in the US, what are we talking about? We are talking about the standard of living of the average American. So we need to talk about the average American. So how do we get the income of the average American? GDP, remember, is the income of all Americans. It's their combined income is what it is. Is that correct? From our circular flow idea. So how do we get the income of the average American? We do it by dividing real GDP by the population. This is going to give us a dollar amount per person, right? So in 2011, US real GDP was this much. Now, what kind of dollar is this? Well, it doesn't tell us which year was the base year, but you can be sure that some year was chosen as the base year. So I'm simply going to put BY for base year below that dollar sign. Right? So these are dollars from a particular year. We don't know what that year is. It hasn't been told to us here, but some year has been chosen as base year. So these are base year dollars, right? And the US population was 310.1 million. So when you do the division here, we arrive at real GDP per person of 42,206. So this is the average real income of an American then in 2011. Another name for this is per capita real GDP. Per capita real GDP. So this is a better measure of the well-being of the average American. So rather than look at the income of all Americans combined, we now divide by population to arrive at an average figure per person. Not every American, of course, makes this. Some make much less, and others make much, much more. Correct? But this is an average. Now, in 1961, real GDP per person was $15,754. Again, what kind of dollar is this? Same base year dollars. It's the same dollar. That's why you can compare them. A certain year has been chosen as base year. We don't know what that year is, right? But you can compare these two dollars. This is a base year dollar also. So these two may be compared. And so what does this tell us? It tells us that on average, Americans are almost 3 times as better off in 2011 as they were in 1961. Right? So there's been this vast increase in the average standard of living in the US. Back in 1961, not every household had a phone even, right? And in the American South in particular, many homes didn't even have indoor bathrooms. You had to go outside to an outhouse. You follow me? And so things have greatly improved in the States since then. Okay? Okay, so how do we figure out what's happening to our standard of living? And here we need something called potential GDP per person. And what is potential GDP? Potential GDP is the value of real GDP when all the economy's resources are fully employed. In other words, this is like the maximum GDP that the economy can produce. If all the land, labor, capital, and entrepreneurship were fully used up. Correct? So remember our PPF? Remember our PPF? I'm going to draw a PPF here. So this would be like being on the PPF as opposed to being inside it. Right? We're using up all our resources then. So potential GDP then is the potential. What does potential mean? It's what we can do if we could. For instance, I might say to you that your potential grade in this course is an A. That means if you apply yourself, you might get an A. Of course, you may not get an A, which means that you have fallen short of your potential. Correct? So that's what potential GDP is then. And here we have a graph of potential GDP per person. So we've divided by population, right? The black line is the potential. The red line shows us what's happening to the actual real GDP. So this is actual real GDP per person, and the black line is our potential. And you notice here that sometimes we do better than our potential. Like, for instance, here we're doing better than our potential. But here we're doing worse than our potential. Here we're doing worse than our potential. Right? So you see here that we have this positive trend. Our potential has been growing over time, largely because of improvements in technology and so on. Right? So our potential has been growing, but our actual behavior has been somewhat it's not erratic, but it's been sometimes better than potential, sometimes a little worse than potential. So we go up and down around that black trend line. So you can think of this as the trend, the long-term trend. That's our long-term trend in our standard of living, right? But sometimes we do a bit better, sometimes a bit worse, right? So we've already spoken of the business cycle, right? There are 4 stages of the business cycle, and I've already spoken about that: expansion, peak, recession, and trough. How did I draw the business cycle before? I drew it like this, correct? I'm going to make a slight adjustment now. I'm going to draw it around the trend line. So this is time again, and this is real GDP. And what's our potential? Our potential or long-term trend is like this, correct? But our business cycle is around that. So as opposed to drawing it like this, I now draw it around a positively sloped trend. Right? So our economy is growing over time. Sometimes we do a bit better, sometimes worse. So this here is, this period here, well, that's an economic expansion. This, on the other hand, this is a recession. So we have expansions followed by recessions. But it all happens around that long-term trend. Yes? Here we have a small part of that diagram. We're sort of magnifying it. Right, so here we have a recession. What is a recession? A recession is defined as a period of falling production that lasts for at least 6 months. So how do you identify a recession? If real GDP of the economy falls for 2 consecutive quarters, that's when the government announces that we are in recession. So that's the definition used by our government. Okay? Now, comparing standards of living among countries. Now, what did I say we do here? We have a Mexican amount, so US per capita real GDP, and we have Mexico's per capita real GDP. This, of course, is measured in US dollars, and this is measured in Mexican pesos. Right, so how do we compare them? Now, the traditional thing to do is to use an exchange rate. So we use the prevailing exchange rate to convert the peso into dollars. What is the prevailing exchange rate, somebody? Is there anyone here who travels to Matamoros often? Any idea what the prevailing peso-dollar exchange rate is? 13 pesos to the dollar. So we would basically then take this peso amount and we would divide by 13. Is that right? But there is a problem with this. And I'll tell you what the problem is. The problem is that costs of living are quite different in these two countries. Right? A haircut, for instance, is much cheaper in Mexico than in the States. Lots of people go across the border to get dental work done or go to the doctor in Matamoros. Am I correct? Because things are much cheaper there, even when you convert into dollars. Right? So this exchange rate calculation, conversion, is not accurate, economists argue. Why? Because the costs of living are so different in the two countries. So what we really ought to be doing is this. So, by the way, how do we get real GDP? We took the physical quantities, the 100 pounds of apples. We took the 100 pounds of oranges. And what we do then? We multiply this by prices. Is that correct? Prices from the base year. So this was being done in Mexico also, something similar. Right? And the US calculation gave us our real GDP, and the Mexican calculation will give us its real GDP. And then we do the exchange rate conversion, right? But economists argue that that is perhaps not the right thing to do. What we really ought to do is we ought to take the output of apples and oranges in Mexico. Let's say that Mexico produced 50 pounds of apples and 50 pounds of oranges. Now, what would we be multiplying these with? We'd be multiplying these with what? The prices of apples and oranges in Mexico in the base year, right? But instead of doing that, economists argue that the better thing to do is to use the same prices as in the States. We use US prices, in other words. Now, when you do that, you arrive at something that's more comparable. You see, otherwise, the Mexican number is going to be a little too small. You see, my point is this. If you were earning, let's say, $3,000 US in Mexico, what would that make you in Mexico? Would you be a middle-class person in Mexico? Somebody? Would you be pretty well off with $3,000 a month? Somebody. Right? On the other hand, $3,000 a month in the States, well, would you be better off in Mexico with $3,000? You would, right? That's my point. Because lots of things are way cheaper there than here. Right? So when you do the peso to dollar conversion using the exchange rate, the Mexican standard of living will seem too small as compared to the States. In reality, the Mexicans do much better because their cost of living much lower. You see? So this is the argument being made here. We use a common set of prices called purchasing power parity. So instead of taking US physical output and converting it into US real GDP using US prices, and taking Mexican physical output and converting that into Mexican real GDP using Mexican prices, we don't do that anymore. We take Mexican output and we value that at US prices, at US base year prices. Do you follow me? That will give us a better sense of how well off the average Mexican is as compared to the average American. Okay? Just give me a minute. Just make sure that we have a couple of things here that we have to do, but we'll do this next class. All right? Stop here today.